Okay, Crystal, I've given you about an extra half hour to a quarter hour to get online and if they got cross communication or what, but obviously you're not on. I hope that's not a problem, but you will need to let me know that you have seen this class. As I said in the recording I did on Tuesday, and I don't know if you've watched that either. Um, we know you need to pass this class, so we need to have a conversation about what is going to be required for that for you. So um, so we need to be able to get that going because we can't we can't have this class not work for you. Healthcare finance is a big subject. I am actually in the week 1 readings and tools. There, all of the chapter PowerPoints can be opened, and we can scroll down. I've opened all of them for this. We'll go through that in a minute. I want to go to the bottom and talk about the systems that we integrate. Systems management is something that is a part of the organizational management stream that is used by most organizations. The systems approach or perspective is really based on the idea that unless you are a one-person operation, you have multiple systems that are in place. And even when you are a one-person operation, you have to have these various systems in place. And one of those pieces of the organization that's an important part of the system is the financial system, which is what we focus on here. And the financial system itself is composed of several smaller systems. One of those is the original records. We have transactions that require record keeping. And in a healthcare organization, the documentation of who's been given service, payment, the payments by the patients, payments to our contractors, all require records being kept because we are audited, not just by financial auditors, but by Medicare and so forth. All of the government agencies that get in this require a lot of auditing as well. The information system is the way we keep the records together. That can be a computerized system, or it can be the old file system, depending on the organization, or maybe both. In many cases, you'll walk into a medical office and you'll see only a few computers and people there, and they'll call up your records. That's the modern system. But many older practices, if you look back, there will be file cabinets full of records that have not been converted to electronic format, even though everyone's supposed to be using electronic records these days. So we need to keep records of the information system needs to record all of that stuff and breaks it down into, generally speaking, it's like a bookkeeping system. And you've been through this with your accounting classes, accounts payable, accounts receivable. Then you have the other accounting classifications of assets as long-term assets, short-term assets, depreciable assets. Then you have your other records of your direct, indirect, and fixed costs. So there's a lot of different records. There's a lot of different types, and our information system has to account for this. The accounting system is generally we use GAAP, the generally accepted accounting practices, and the accounting system allows us to understand where we are. Our accounting system should allow us to know what we have taken in, what we have spent, what our obligations are, and what our current fiscal health is. Are we taking in enough to pay the bills, for instance? That's question one. And question two is, of course, are we taking in enough to not only pay the bills, but to perhaps make a profit? Bills also include our salaries, by the way. So in some organizations like professional companies, professional corporations, which most medical offices are structured as some form of professional corporation. However, nursing homes, long-term care facilities, rehab facilities, hospitals, and so forth are going to be organized in a different way. It'll depend on whether they're for-profit or not-for-profit entities. So the issue here is going to be the accounting system will reflect that, and someone within the organization, in a small organization, it's going to be the owner or the manager or some other person who's designated to keep track of the finances. Should be able to look at that every single day and see where the company is and keep tabs on not just whether money's coming in, but whether we're paying our bills and so forth, because we have to do that. And the reporting system is something that comes out and comes out of our accounting system, and we have to have a way of being able to understand the data. Most common report forms are the balance sheet, cash flow, profit and loss statements, and so forth. You can set up a lot of things to a lot of different kinds of reports depending on what you need to know. But the real purpose of having all of these reports is to be able to make sure that the company is staying afloat, that we can do our budget planning and set maybe price increases. Given what you want to do, you're going to be constrained by Medicare and Medicaid, and that's going to be a whole different kettle of fish. You are not expected as a general manager of an organization to be an accountant or a financial analyst or a lot of different things, but you may have to manage several different roles. Depending on the structure of the organization, you may have to be the HR manager. You may have some people working with you, but you may have to do that. You probably will have someone who is going to be in charge of making certain that all of the various systems get into place and accounting is done, and bookkeeping. Your accountants probably will be outside people in the kind of organization you've said you're interested in working with. So you'll be managing your contractors as well. You'll be negotiating contracts. If you're negotiating a contract, you have to understand how to make sure that that contract is going to meet your budgetary needs. So that means you need to know everything there is to know about the organization. So let's see. So let's go back up now and just take a look. What I suggest you do, the readings and tools each week should have a listing of these PowerPoints. If you click on the little PowerPoint icon to the left of the title, it'll open up this preview. And the nice thing is, if you've got a lot of chapters, you can open them all up sequentially and just go through them. So what I would suggest, quite frankly, is that you look at doing this, going through the chapters. There's a lot of material here. I would go through the PowerPoints personally. And if you look at this, you can look at each individual chapter that way. This isn't working right. Okay. Okay. So there's a lot of information that's here. The overview is there. If there's something you want to get a little more detail on, then what you want to do is, this introductory chapter is a good one. You may want to read what they say in the chapters about such things as the three views: the financial view, the process view, and the clinical view. There is some information. This is there. They're all part of the management. Now, in a small organization, one person may have to have a couple of these. If you're working in a practice, for instance, you'll have a clinical manager. You won't be determining what the clinical work is, other than making certain there are people there to schedule it. But you'll be responsible for financial, and process generally means HR and IT and other things that are within an organization. So again, you have some descriptions here that can give you some overview of the work. So you can call it up and take a look at it. Then there are the four elements of financial management: planning, controlling, organizing, and directing. Often these middle two will be grouped together, as organizing and directing can be considered a subset of controlling. So there are some places, some texts will talk about the three elements, but there are four. Controlling is a more complicated thing. So controlling is to make sure each area of the organization is following plans that have been established. And then organizing and directing is, so this is the sort of the strategic view, and this is the tactical. Decide how to use the organizational resources to carry out those plans. Decision making is probably one of the more difficult things that you have to do, because you're going to have to look at, when you make your decision, you're going to have to think about consequences and effectiveness. And you may find that it's difficult to do things that give you the good outcome and are the most effective. It's an interesting way of thinking, different. That's a whole different topic, of which I've written a book about. So types of organizations: profit making, we call those proprietary, or not for profit or non-profit. Let me make a statement here. Non-profit doesn't mean it doesn't make a profit. What it does for tax purposes, it's a tax designation. For tax purposes, it means that the profits of the organization are put back into the organization as opposed to paid out to shareholders. There is a fuzzy line there. And a lot of times the IRS will look very carefully at the annual statements of not-for-profits to see that indeed it's just not a conduit for money for which the organization doesn't pay taxes, money going into a founder's pocket. It's a fine line. Profit-oriented, well, they pay taxes. They can be a number of different kinds of structures. I don't know if you've had a class in organizational structure, but you have corporations, you have partnerships, and you have sole proprietorships, you have LLCs, you have PCs, professional corporations, you have LLPCs, limited liability professional corporations. There's a lot of things. The nonprofit oriented organizations, as I say, it's a tax designation. And they often use a lot of volunteers. Government organizations don't pay taxes. So the organization charts, structures, it's under you. One of the things you want to do when you move into an organization is really study the organization's structure, the organization chart, to see what the formal lines of communication and reporting are, and how many layers. There are hierarchical structures, as you know from some of your management classes, and there are flat structures. Small organizations tend to be flat. Large organizations tend to be very hierarchical because of the complexity of having a large employee base. Financial and managerial accounting, you've studied both of those. Financial accounting is generally aimed at the export or the external reporting that's required. If you're a for-profit company, for instance, you have to file quarterly reports and annual reports with the securities, with people. If you are a publicly traded company, you have to file a lot of stuff with the Securities Exchange Commission. And so the financial accounting is for that external reporting. The other thing is that you have to follow GAAP, of course, and the other part of this is that, of course, our biggest third party that we talk to is going to be the government, Medicare and Medicaid, when we're filing for reimbursement. But also we need to keep records for our insurance partners as well. Managerial accounting, however, is it is what we use to run the company for internal use. Managers use it. It is not something that we have to have a GAAP of principles followed, and we're using them for planning day-to-day operations, planning for strategic planning, looking at budgeting and other aspects that are not part of the reported information. So we go on now to the next chapter. We want to get in here and looking at financial management systems. So we have the 4 segments that we talked about: records, information system, accounting system, and reporting system. These separate elements work together to give us the end result, which is a financial picture of the organization. So you really ought to look at figure 2.1 in the chapter to look at this. We have flow sheets to look at as well. Who's responsible for what piece of information as it enters the system. This is like a project management issue. We need to the information has to go up through various steps that may be handled by different people. So, so there's a couple of flow sheets here. We've got, here's one, which is looking at patient information. So what happens is that you receive a call, record a message, look at the review of the records, check all the things that you need to do, make sure that everything is done. The patient is the initiator, and there are a number of different things. So the receptionist will make sure that that all of this information is taken in. The MA will do ask many of the same questions, and will mark the bill that they have, and then the coder will do the charting and the labeling. So we have other kinds of things. A referral. So there's a couple of different kinds of things to look at that get handled. This is a piece of the pie. The chart of accounts is an organizational structure. You know what the chart of accounts is from your multiple accounting classes that you've taken, and it is really maps out our money so that we can see how the cash flows are functioning, how we're looking at the sources and uses of funds. Basically is what we have that we're looking at, and what it does is it should be in a very clearly organized manner, so structure, so that it's easy to decode. For small organizations, it's a lot easier to deal with than say a large facility. My father's been in a couple of nursing homes for rehab, and there's hundreds of patients. There are equally hundreds, not as many as patients, but hundreds of employees. Actually, probably more than patients, because of course there's a lot of infrastructure that never sees patients. But there are a lot of other things that need to be done. So no one person is going to down on the line is going to see everything, but it all goes up to the ultimate financial manager, the person who might be the chief financial officer or whatever they call them in the organization. So someone needs to know it, and every one of these is different. Chart of accounts. So you've got a financial statement element, then you've got primary and secondary subclasses. So we have an asset, a current asset, and maybe petty cash at the front office. Another format might be an entity, what we call an entity designator. In other words, if you've got a bunch of different organizations, if it's a system, then you might have several hospitals, you might have several practices. So the entity designator is there. The fund designator, there's some general funds, usually some sort of element. Then we have revenue or expense. We might describe, say, a lab, and then maybe who's actually paying or who's being paid out. This is an expense, so clerical salaries. Also lab tech salaries. So there are yet other that can be used. It all depends on how their accounts are organized. So one of the things you want to do is take a look at the chart of accounts when you go into an organization to understand how all this information is recorded, stored, and reported. So you capture the transactions, then you create you put things into to the subsidiary journal, then to the general ledger, and then you go back through and follow the usual accounting procedures. The annual management cycle depends on the organization. Daily and weekly reports. In a small organization, you may only really go through weekly reports. I suggest that you have to do at least weekly reports. The bigger the organization, the more interested you're going to be to look at the dailies. And quarterly reports, these are really, and the statistics, and that can be just about any kind of statistic you want. And then the annual year-end reports, which are used, of course, as part of the basis for your annual tax filing. Your year-end, well, you need to know what your financial year is. Most organizations do not. A small organization might run on a calendar year, but any larger organization is generally going to run on a fiscal year, which will be whatever they have chosen out of the possible choices. And it can be, you can have it correspond with calendar quarters, or it cannot. Doesn't have to. When we are doing communicating with others, you need, when you go in, find out what are their reports that they use, and are they structured. But always your reports are generally summary, and then they're accompanied by by appendices with the data. Okay, let's take a look at chapter 3. Assets, liabilities, and net worth. Okay, you've seen this in your accounting classes. Assets and liabilities. Assets are the resources that have expected benefits to the business, meaning cash on hand, meaning equipment, meaning property. So these are all assets. And accounts receivable are an asset because we expect that money to be receivable. Notes receivable, this is related to financial transactions that have a cash flow over time. Inventory, land, buildings, and equipment. Liabilities, any outsider claims, in other words, debts. Outsider claims can be any bills that we owe, economic obligations, accounts payable, and of course our debts are things like mortgages or loans that we have negotiated. So some of these payroll taxes due. These fall under the outsider claims. Payroll taxes due, and so forth. You may have bonds. It's not unusual for hospital systems to use bonds as a financing method. Bonds are issued, the money comes in, and then we pay them just like a debt. Net worth is the difference between assets and liabilities, basically. Between what we have and what we owe, basically. So we have a lot of different examples of what goes into the terminology of net worth. We have owner's equity, which is for sole proprietorships or partnerships. For-profit corporations, you have capital stock and retained earnings, and in not-for-profit companies, it's the balance of funds. So assets, liabilities, plus net worth. Assets, short or long term. Okay, liabilities can also be short or long term. So we need to follow those. Again, those are terms that come in for our accounting. Okay. So for-profit companies you can name almost any company that you're familiar with that's publicly traded, something like Apple or Microsoft or IBM or UC Health is an example of something that is set up as a not-for-profit. Okay. So we have a short-term asset would be accounts receivable, inventory, and cash. Inventory, we don't generally talk about inventory as a long-term asset because the idea of inventory is that you use it. And there's, of course, the issue of turnover of the inventory. Long-term asset would be hard assets, real assets. Short-term liabilities, things like payroll taxes due, mortgage payable, and notes payable that's due in the next, or rather accounts payable. These are all short-term liabilities. Long-term are your mortgage, and and the non-current means the one for this period, and then any notes payable in the next 24 months. So let's look at this chapter, which is for revenues. Revenues are anything that comes in that generates money. Services, fee for service, discounted fee for service, and any prepayment before service is delivered. A lot of times medical facilities, there's no prepayment for that. Although if you're an insurance company, that might be different. Deductions from revenue, these are contractual allowances. Now, that is the difference. You've seen it. You've seen your medical bills. The doctor may charge you $300 for the visit. But after the contractual rate might be $75. So those are deductions. It's not uncommon for different insurance plans to pay different contractual rates for the same service. So you need to have a system that recognizes that health plan A is going to pay $75 of that $300, but health plan B might pay $80. Variations in for this visit codes. Here's a couple of different payers, so look at the range here. It runs from $10 to $45.75, and this other payer, this other code runs from, again, $10 to $70.75. So it does range a lot. Other deductions are bad debts. In other words, you can't collect it because the person perhaps has died and there's no one that is responsible for those debts, or they simply are unable to pay. Ultimately, you write them off. Okay. So let's Go here, expenses. Expense is every used up cost that is deductible from, in other words, what you have actually paid. That's what they mean by used up. The distinction between the expense and cost. Cost is the amount expended in consideration for goods or services or property transfer, etc. Expired costs are used up in the current period. So the cost of your mortgage, if you use up the monthly, the current payment, which is for, say, for this month, when you pay it, that's an expired cost. Unexpired or not used up be matched against there. Costs and charges. Charges are, there's a difference between cost and charge. A lot of people will interchangeably use them. Charges are revenue and costs are expenses. So again, the difference, and you probably remember this from your accounting. Disbursements for services are an expense stream. So for us, we go to the doctor and we have a copay. That's a disbursement for us. When the disbursement for expenses, the payment when the expense is incurred does not require it to go into accounts payable. Accounts payable are money that's owed that hasn't been paid yet. And there's lots of reasons. If you go through many businesses, there's like a 30-day payment period that you have to indulge in. That is, so any money due during that time is part of accounts payable. And you know it can get pretty complicated after that. So we use various forms of groupings to look at this. General services, say in a healthcare system, might include all of these different costs. Support services, take a look at this: pension payments, Social Security taxes, etc. So we can look at things by diagnoses, or DRG, and currently by the cost code. So we've got a lot of examples here. We can look at care settings as a grouping. So take a look at some of those. So look at some of the exhibits here. Homeless intake center. We've got costs, food, supplies, utilities, telephone, etc. for the month of, for a specific month. Annual cost reports are required for Medicare and Medicaid. Don't wait for the year. Make sure that those reports are kept current throughout the year. So you need to study how the financial records are organized in your whatever organization you go to. Okay. So look at this particular example is of this particular group, MHS. The expense group their expenses for the ICUs into its own cost center. Lab and laundry expenses are likewise grouped into their own cost center. So we set up a spreadsheet that looks at that. So in the intensive care unit, there are a number of things that are needed: drugs, salaries, etc. The lab may look at supplies and salaries. Note that salaries are common. Uniforms, repairs are all there as well. So if we take a look at some of these, now we can move on to the next chapter, which is cost classifications. So we're approaching, I'm going to keep going for a little bit. There is a distinction between direct and indirect costs. These are an area that is kind of part of accounting and finance, which are direct and indirect costs. Direct costs can be associated with a particular unit, department, or a patient, depending on how you want to arrange things. And those direct costs are those directly attributable to the object, okay, which is to say unit, department, or patient. Distinction between indirect and direct. Indirect cannot be associated with a particular department or patient. Let's just look at a nursing home. You've got, say, a hallway with 12 rooms on it, and you have 2 aides and 2 professionals. You've got a PT, maybe an OT, you've got your physician or your practitioner. You may have a pharmacy within the organization. The pharmacy and the aides and so forth can't be attributed to a single patient. So they're indirect costs associated with how that patient is accounted for. The drugs that patient receives from the pharmacy, yes, those are direct costs for that patient. The pharmacist's time, though, is an indirect cost. So we've got direct costs. Depends on, we're assuming here that this is attributed to a specific clinic. So managed care, marketing expense, telephone expense, and ER medical supplies, those are direct costs. The indirect costs are taxes of varying types, real estate, liability insurance, utilities for the entire facility. You take a portion of that and account them against those departments. So another way of looking at the direct costs are for the sole benefit of one entity, and they can be tracked. The drugs for patient X, they can be tracked. Indirect costs are for the benefit of the overall operation. So the time of your nurses and therapists and others that are there depends on how it's allocated. But for those specific people, we have to allocate that. The overall costs of utilities and so forth. So we have direct and indirect costs. Direct costs are traced directly to that object, indirect allocated. Why is the difference? The manager, in many cases, is really responsible for the direct expenses, whereas and not the indirect expenses. So you may want to study those examples in there. Okay, here's a direct cost for, say, an organization. Direct costs: ambulance salaries and benefits, nurses' salaries and benefits, vehicles, supplies, uniforms, etc. All the things that can be ascribed to the individuals there. Indirect costs: the overhead, facility, and administrative costs. So we look at another term here, the responsibility center. So take a look through and read through these things carefully and study them, or look at the book. There are several examples here that can give you some ideas of the distinction there. The product and period costs. Well, uh, um, product cost represents something that's been manufactured and placed in inventory while waiting to be sold, or purchased and placed in inventory while waiting to be sold. Then when it's sold, it's removed, matched with revenue, and recognized as a cost. A period cost is not connected to that. It's matched with revenue on the basis of what period the cost is incurred. Um, uh, the term comes from a span of time in which matching occurred, known as a time period. Medical supply and pharmacy departments have inventories on hand. They use the product cost method, removing inventory and then matching it. Healthcare, however, is a service business. One way to think of product costs in this instance is it's necessary for the department to deliver the service, while period costs are necessary to support the existence of the organization. Okay. Let's pop down here. Okay. Cost behavior. We have fixed, variable, and semi-variable costs. You've run into those before. Fixed are those that do not vary when activity levels change. And variable are costs that vary in direct proportion of activity levels. Okay, there's lots of examples. Semi-variable vary when the activity change, but they are not in direct proportion. So we have to look at that. And we have mixed costs, which you have to look at. The predominant, the mixed cost, you have to determine whether it's more fixed or more variable. So we look at, we examine the methods in the chapter, and you need to just study those. Cost is, so we can do this through the high-low method, looking at a high level and a low level, look at the differences, and examine from that. We can use all sorts of graphical methods. These are kind of abstract accounting things that may be very, very important to someone like Linda. But that's why you have financial people helping you. So we, so you want to look at the fixed and variable costs, say, of an operating room. Fixed costs are basically the cost of having that room there. It means it's a part of the mortgage or the lease on the building. It's a part of the equipment that you have. The fixed, so those are often fixed. Variables: surgeon's time, nursing time, cleaning time between, because we don't have surgeries every day. We don't have the same number of surgeries every day. So it really can be kind of an interesting thing to try and figure out. There is our fixed costs can be set. Okay, so 40%. Let's take a look at this example here. This is just a calculation example. So we can look at the contribution margin. So let's look at what the definition of contribution margin actually is. It's a variable cost that's deducted from the net revenues. Then that's the contribution margin. That is then reduced by your fixed costs as well. So we see the revenues and then the variable costs. If our revenue in this example is 1.26 million and our variables are a bit over 600,000, then our contribution margin is that difference. and that is contributing to fixed costs and profit. So we look at, in this example, if the fixed costs are this much and the contribution margin is this much, the difference between them is profit. So we'll just keep going because we're getting close to running out of time here. Okay. So the contribution margin is something, cost volume profit ratio, the break-even point, okay, is the point when contribution margin equals the fixed costs. That's fairly even. So we know if we understand our fixed costs of running, say, an OR, we can calculate what we need to have left over after the variables. And so we use that as a way of determining what charges are going to be there and what we need to have. So we do have, if our variable costs are sufficiently above our let's just say here we have our variable cost line. If you look at this, our variable costs are in addition to our fixed costs. If, however, our variable costs, our variable cost line is actually below our fixed line, then we have some problems with profitability. So we look at that. We look at that information. You need to take a look at what it's going to cost. If, again, our variables have to be more than our, have to be more than our fixed cost line. Okay. We won't go through these examples. Okay. Let's go into here. So looking at the various tools, we have to look at inventory. Inventory is all of the stuff that you have for sale, whether you produce it or whether you buy it. It's a current asset on the balance sheet because the expected time for sale is 12 months, and we prefer it to be even faster than that because money sitting on our shelf is doing us no good. Various things that are there. The completed inventory item is sold. So we recognize then that's how an item moves out of inventory and recognized as a cost. We balance the cost of goods sold against our inflow of cash. And in the case, so it moves out of the inventory and becomes cost of goods sold on the statement of our accounts. Really we look at looking at buying our inventory, and then we record the income from the sale. So we have beginning inventory, purchases recorded. So we have net purchases equals the cost of goods available for sale. We subtract the ending inventory, and then that's our cost of goods sold. Gross margin is the difference between cost and revenue. For drugs, it's easy. If you buy a drug for $20 and sell it for $40, then our gross margin is 50%. It's the difference between sales and the cost. So the gross margin might be, and gross margin on many of these things is pretty high. And you can readily compare that to other things. Inventory methods, how do we value it? Two most commonly are first in, first out, or last in, last out. Depending on the benefit is generally that the first in is, because of inflation, costs generally less than the last in. So if we are move out first, costs have risen, the first in, first out will be higher. So we might, our accountant will decide what is best for our reporting, whether we're going to use first in, first out, or last in, first out. Now, keep in mind that some things have expiration dates, so we can't always do last in, first out accounting because theoretically, if you've got stuff that's been on your shelf past its lifetime, you can't sell it. It becomes, you have to write that inventory off. So, so we look at generally we'll let our accountant decide what's best for us, but we have to keep in mind that the inventory effect can, this is sometimes used because we have spent that money and we're just usually determining what's going to be used. Now there's the other, which is the weighted average inventory, which is basically total cost divided by total units, or no method at all. The weighted average, if there's no method, the inventory is never recognized. This is not necessarily good because it can be misleading financial statements. Inventory tracking. So we have to track our inventory. There's the perpetual system. If we're making widgets, who cares if you've got a widget on the shelf that has been there gathering dust for 10 years? If this hasn't changed, it hasn't changed. They don't expire. Drugs are different. Medical supplies are different. They all have expiration dates. So we have to be very, very careful about how we make use those. We have to be careful to recognize when we have to write things off. Inventory turnover tells us basically how fast the inventory is sold, which is we have average inventory, and then we have so we have the cost minus the cost of goods sold. The cost of goods sold is divided by the average inventory, and that gives us our inventory turnover. So basically that's a ratio that shows how fast inventory is sold. There's another reason, storing inventory. There's another reason you want a high turnover, and that's because storing inventory is expensive. You have to have space for it. Space is expensive. So there's some examples here of various things. Depreciation looks at fixed assets and looks at the value of that asset and allocates a yearly write down of the cost over the expected lifetime of the asset itself. Computers are a good example. We expect computers to last, say, 5 years, and so we spend $1,000 on a good computer for our system. We can write off $200 a year if we use a straight line depreciation. And there are And then there's the salvage value or residual value at the end. It's not depreciated because it's expected to be recovered. And so the depreciation is handled special ways. We won't go into a lot of details on that. So we want to take a look. Our income statement, we have a depreciation expense of $25,000 that goes to the income statement. The balance sheet reflects a reserve for that depreciation. So we've spent the money, but we are only taking part of it. The net book value is a balance sheet figure that represents the value. So there's some examples of that. Okay, there are 5 methods. We have straight line, which basically is if it's something that you expect to last 10 years, you'd take 1/10 of it a year. Accelerated methods, there are several of those that are kind of abstract. And units of service, depreciable amount to how often you can use something. This may apply to equipment, say in a PT facility. Straight line, okay. There are other computations. Okay, this is not interesting. This is not coming up. What's going on here? Thank you. Okay. Okay. All right. There are some other examples in here for that as well for you to look at. Okay. I guess I'm taking up too much memory. Okay, so there's several other examples that you can take a look at. Let's go on to the last chapter here. It's not cooperating very well with me, is it? Okay. Okay. All right, so I don't know what's going on with my computer. It's just not really coming up with this information. There. Perhaps I just had way too much information up here. Okay, here we go. All right, so, and then we have tools okay, staffing is the responsibility of the manager. we have staffing requirements, okay? So we need to understand what our staffing requirements are. You have to have people on site sufficient to fulfill all needs. If you're working in a long-term care facility, which is what you've said you were interested in, you'll need to have lots of different requirements, and you'll have to be having people on staff in many positions 24/7. Doesn't matter what else is going on. You're going to need people in the kitchen, or at least have somebody that's there capable of fulfilling those duties. We have to have enough people to provide the care that's needed. Some facilities, some functions don't require 24/7 care. If you have, for instance, in-house PT and OT, probably don't need somebody there 24 hours a day. You probably aren't doing that. But if you do have, but you do need nurses and aides and professional care. So productive time, net hours on the job. Non-productive is basically the time that employee is not on duty. That includes vacation days, sick days, holidays, etc. So we need to be looking at all of this. I'm going to run into trouble for the rest of this, it looks like. Okay. So FTE, full-time equivalent of one employee paid for a year. It includes both productive and non-productive. 2 people working half-time is the same as 1 full-time equivalent. So what we do is we look at the needs for that, to look at calculating staffing needs. Okay, let's see what comes up next. Okay. Why do we do this? Well, we need to do this because we need to be able to plan and budget and look at what's going to happen, say, if we expand. If we have a nursing home and we decide to add a rehab wing, how many FTEs are we going to need? How many rooms are we going to have? How many patients do we expect to have in there? So we are going to be looking at all of those. And we need to be prepared to make those decisions. Okay. So we use the calculation and we tie costs to that. So we have to, these are variable costs. Wages are variable costs because they are, even though we might think of them as fixed if we have full-time equivalents, they're still considered variable because different people will get different amounts and we can't place a specific number to them. So we need to tie our costs to that staffing. Staffing is a critical issue in healthcare. Okay, I'm going to let this go now because I've run into problems. I think I just have way too much stuff open. And the way we record those are using varying things varying tools for our accountants. Again, you know that you've seen this in your accounting classes. So okay. Now we're running out of this. Okay, so I'm going to go back here to modules. and once again remind you of a couple of things. Okay. Okay. So we have our week 1 discussion. You need to way too much stuff up. See if we can go back here. I don't know that we can. Okay, so your week 1 discussion is you need to get started on that. It was supposed to have been, your original post was last night. Why is a general understanding of accounting and finance important to a healthcare manager, even a manager who does not specifically work in accounting or finance? Give some examples from the readings of the kinds of information you need to manage healthcare departments. So what you need to do is be looking at that, get that done. We have an assignment this week, which here we are. Let's see if I can bring that up. The assignment this week is a paper. You're going to be discussing several things. You're going to discuss 3 different topics of a list, and then talk about how you feel about providing financial information to your employees. So you need to get started on that. I want you to watch this and then send me an email, and the code word for this week is Lugano, Lugano. So please do that. I will be sending you an email as well. So I'm going to stop this recording and close the meeting. And I'd like to know where you were. I thought we had a date, thought we had a specific date for Thursdays at 10. So we need to get that settled. And I hope you didn't drive down to campus today.